Many individuals are acting like there is no economic downturn happening, even though clear indications of a recession are evident. The biggest global real estate holder, Blackstone, managing $1 trillion in assets, reported a significant drop in profits and earnings, signifying potential economic instability extending into 2024. Witnessing a dramatic plummet in profits by 73%, Blackstone, the world's real estate holder-owner, has raised eyebrows across the real estate sector and the wider economy. The Wall Street Journal indicates that Blackstone's earnings took a hit due to a decrease in the value of its property portfolio. The company's net revenue fell sharply by $558 million to a mere $151 million in one quarter, marking one of the poorest results in the last 10 years. It's vital to understand the implications of this situation, as it could indicate a broader downturn in both the real estate market and the economy at large. Numerous other finance-related companies are also sharing news of poor earnings this year. For instance, Blackstone reported a 73% decrease in income year over year. Bank of America saw a 56% drop. Citigroup's earnings plummeted by 173%. JP Morgan declined by 15%, and PNC fell by 43%. The average decline in profits for these financial institutions was 27% year over year. One of the main reasons for this income decrease is the rising interest rates. The Federal Reserve's current rate increase cycle has elevated the short-term American interest rate by almost 52%. Consequently, interest rates have risen across the board, affecting yields on everything from the 10-year Treasury to the 30-year fixed mortgage rate. This rise is detrimental for financial institutions as their capital costs rise due to increased rates. They now pay more for deposits and to shareholders when they fundraise, leaving them with smaller margins when they lend or invest in the economy. Considering these factors, the economy's health appears somewhat in jeopardy. Please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe helps support this channel and keep us motivated to keep making you great content. Thank you. Now, back to what I was saying. Blackstone's recent earnings report shows an interesting trend in their stock performance. Even with a significant 73% decrease in their income, the group's share price climbed to $123 per share. This comes remarkably close to the all-time peak observed during the 2021 bubble. Despite this rise in share price, some concerns arise about the overall health of the stock market. A popular tool to evaluate a stock's worth is the price-to-earnings ratio. We understand the company's earning capacity by dividing the stock's current market value by its earnings. Consider Blackstone, for instance, whose PE ratio, as per Google Finance, stands at 52. This poses a red flag considering this ratio is exceptionally high. This figure suggests that Blackstone's stock may be overpriced, which could alarm prospective investors. We observe a peculiar pattern where the stock prices continue to rise, but the income reflects a slump, aligning more with the long-term average. Over the last decade, Blackstone's share price and income have maintained a close correlation, even during the boom years of 2021. However, recently, there's been a disconnect. The stock price is soaring while the income is lagging. This trend, seen globally in the current stock market, is reason enough for concern. The economic bubble is in the air as the value of stocks, property, and all economic elements appear to be disengaged from their essential determinants, primarily income and profits. These components typically indicate a company's worth, yet their significance seems to diminish in our current climate. People fervently predict future improvements, seemingly overlooking the vital role of income and earnings. This trend is particularly noticeable within the present housing market. The real estate sector is encountering difficulties similar to those affecting equity markets. House prices have skyrocketed, far outpacing incomes. By examining the historical data spanning 80 years, we can observe the house price-to-income ratio trend in the United States, a clear indicator that property prices are experiencing an extreme surge as we enter 2024. The house price-to-income ratio stands at 4.5, calculated by dividing a property value of $346,000 by a median income of $78,000. It's noteworthy that this ratio has been this high on a few past occasions. One such instance occurred in 2006. at the pinnacle of the last property market bubble before the substantial slump. Before that, we have to go as far back as 1954, when the ratio touched 4.9, only to nosedive significantly in the subsequent years. Interpretation: if you're contemplating purchasing a house in these market conditions, you're standing at the edge of an enormous bubble. House prices appear overvalued by nearly 30% compared to their historical averages. This suggests a considerable risk of a substantial drop in house prices. Growing numbers of voices in both the financial and real estate sectors argue that the post-pandemic period, coupled with the substantial monetary injections by the Fed from 2020 to 2021, represents a new reality that cannot be directly compared to historical trends. These talks are reason for concern as they indicate a broad acceptance of a new paradigm, a harbinger of a potential major shift. This new normal theory is gaining traction, fueling beliefs of an underlying solidity in the possibly speculative bubble. This sentiment also resonated with Blackstone, who recently made headlines for their financial reports and their acquisition of 40,000 houses across the U.S. Blackstone recently purchased Tricon Residential, a publicly traded Wall Street landlord managing approximately 38,000 single-family homes. The deal, valued at $3.5 billion, effectively makes Blackstone the owner of Tricon's vast property portfolio. However, this does not increase the overall number of homes owned by either company. It essentially represents a strategic realignment, with Tricon's holdings now falling under Blackstone's management. This action is significant as it suggests Blackstone's revived focus on the U.S. housing sector, hinting at the possibility that major Wall Street landlords may be pursuing greater market exposure, particularly given their decreased investment pace in recent years. The fascinating aspect of Blackstone's purchase of Tricon lies in the geographical distribution of the homes acquired. According to Lance Lambert, a respected authority in monitoring Wall Street property owners, the largest portion of the properties now under Blackstone's control is in Atlanta with 7,100 homes. They also have a substantial presence in Charlotte, Dallas, and Phoenix, owning 4,000 homes in Charlotte and 3,000 in each other city. Other metropolitan areas such as Tampa, Houston, Indianapolis, and Nashville also feature in Blackstone's expanding property portfolio. This indicates that these are the urban areas where Blackstone's ownership is growing. Blackstone's recent acquisition of Overinflated Markets is a cause for concern. Specifically, they've decided to invest in housing markets that seem significantly inflated already. Consider cities such as Atlanta and Dallas, for example. These urban areas have experienced a significant surge in home prices, diverging notably from underlying fundamentals. Their value-to-income ratios have seen a substantial increase. Focusing on Atlanta, home prices currently stand at a staggering 32% above their customary levels, a historic high. This overvaluation suggests a potential price decline in the foreseeable future, provided the market inventory can sufficiently increase. Dallas is going through something similar. Housing prices are currently 34% above their typical range, placing Dallas among the most overinflated housing markets in the country. It ranks 5th between Huntsville, Alabama, and Ogden, Utah. These are the considerations Blackstone had in mind during this acquisition. Investing in these metropolitan areas carries a substantial amount of risk, especially considering the nature of the neighborhoods involved. Blackstone has acquired properties in areas with lower incomes and significant overvaluations. It wouldn't be a shock if Blackstone decided to offload a part of the recently acquired portfolio, particularly the less attractive properties. One notable fact about this acquisition is that some assets with Tricon Residential's portfolio underperformed. Here's a glimpse of what Blackstone would be taking control of when you explore the examples of homes owned by Tricon Residential on Zillow. For instance, a property owned by Tricon Residential, which Blackstone will soon own, is currently advertised for rent at $2,150 per month. Interestingly, the property listings revealed that this home has been on the market for 82 days, yet only 8 inquiries have shown a lack of interest in this residence. Furthermore, adding to the concern is the observation that Tricon Residential acquired this property in March 2022 for a substantial $500,000, at a time when the housing market was at its peak. Initially, they managed to rent it out for $2,500 per month for a year. However, when they attempted to re-rent it in 2023, they were forced to decrease the rent by nearly 15% to attract tenants. but to no avail. Consequently, the return on investment from rental income would only equate to a modest 3.8% yield on the purchase price. All these findings suggest that underperforming assets are within this portfolio, and it wouldn't be surprising if Blackstone decided to offload some of these less profitable properties. Currently, there's a surge in real estate investors offloading properties. This is a noticeable trend growing over the past few months. An interesting twist is that these investors aren't just trading amongst themselves, but instead, they're offering their properties to everyday homebuyers via the MLS. Florida has become a hotspot for this activity. In recent times, many investors have opted to step back from the Florida property market. This decision has, in turn, led to a significant increase in the number of available homes for sale. Data from Redfin reveals there are now over 181,000 homes listed for sale in Florida, a figure that has surpassed the average historical inventory levels. Whether in Florida or elsewhere, this noticeable shift in the real estate landscape is worth considering. During the pandemic, the number of homes available in the Florida market had significantly reduced, with only 45,000 that were up for grabs. However, the tide has changed, and now we have over 181,000 homes ready for new owners, which indeed signifies a major change in the property market. This surge in availability indicates that sellers are becoming more prominent, while buyers might not be as prevalent. This trend is particularly noticeable in places such as Lakeland, where the number of homes for sale has reached an all-time high. Similar situations arise in Tampa and Northport, Sarasota, where the property market exceeds regular sales levels. Let's take a look at the Texas housing market. Amidst the height of the pandemic, Austin's home value index touched 819, but it's now plummeting to 34 points below the standard average. This might indicate a decrease in property price tendencies, potentially a reason to delay your Austin home purchase. If we zoom into the Northeast, specifically Hartford, Connecticut, it's a different scenario. Hartford's house price index is 263, indicating a surge in property prices due to various factors. Homes are not staying long on the market, stock is scarce, and there's a minimal price reduction trend. This implies that Hartford's housing market will continue to be robust over the next year. It's a good idea for potential home buyers in Hartford to make their moves now. In contrast, Silicon Valley's housing market has been experiencing a downward trend, with its home value index decreasing by 2%. As a result, there's an increase in supply and a decrease in demand for housing in this region. When the number of homes on the market drastically increases quickly, it could potentially indicate a future decline. This assumption is especially true if the property prices are exceedingly high compared to income ratios, which exceed average levels, and the number of available homes is on the rise. Blackstone is no naive player. As the world's leading commercial property owner, they're highly informed and savvy. Their purchase of Tricon may have been influenced by the advantageous price they secured. With a book value of approximately $3.9 billion, Tricon was acquired by Blackstone for $3.5 billion. This means Blackstone managed to buy Tricon at around 12% less than its book value. This appealing price probably played a role in the deal. Having secured Tricon at a reduced cost, Blackstone now has more room to maneuver if property values or rents decline in the future. Remember the years 2005 to 2007 when the U.S. housing market was bubbling before the catastrophic crash that led to a global economic downturn similar to the Great Depression? The recent spike in housing prices, combined with rising mortgage rates and the possibility of a recession, with a 45% probability according to Bankrate's latest expert survey, has heightened worries among both buyers and homeowners. They're yearning to know when the housing market will crash. Although prices might drop, the impact will not mirror the severity of the Great Recession. A striking contrast between the current and past situation is the strength of homeowners' personal finances. Compared to 15 years ago, homeowners today have a better financial standing. The average homeowner with a mortgage has good credit, substantial home equity, and a low fixed-rate mortgage. The December Realtor.com report reveals that 2/3 of all existing mortgages have rates below 4%. Additionally, remembering the Great Recession clearly, builders have been informed regarding their construction pace. This has resulted in a continuous lack of homes available for sale. Lawrence Yun, the chief economist at the National Association of Realtors, which tracks home sales, notes we simply have a shortage of homes. He acknowledges that some markets might see a drop in prices, but a drastic 30% price reduction is highly unlikely due to the lack of supply. According to Rick Arviello, the head of mortgage company New American Funding, don't expect a drop in real estate prices. The market simply doesn't have enough houses available. Skylar Olson, Zillow's leading economist, shares this view, pointing out that the lack of supply versus demand is causing home prices to climb steadily. She predicts this increase will continue until at least 2024. This information might be music to the ears of sellers, but it offers little comfort for first-time housebuyers aiming to own their own homes. Olson says we're not heading towards a more affordable horizon. On the contrary, some areas in the South have a huge amount of inventory available, which will lead to prices dropping in those regions. The Housing Market Trends Report for January 2024 from Realtor.com reveals that high mortgage rates have hiked up the monthly financing expenditure for an average home by 5.4% compared to last year. This translates to an increase of $108 in monthly expenses compared to what a buyer would have paid in January the previous year. Hidden inflation is also increasing the expenses of many people, leaving it uncertain how many first-time home buyers can actually afford to buy. Will all the inventory continue to be bought up by the corporations like Blackstone? Let me know what you think in the comments below. Thanks for watching, and please make sure you subscribe if you enjoyed the video.